On behalf of our team at HBKS Wealth Advisors, I would like to welcome you to Employee Stock Ownership Plans, Understanding the Business Succession and Financial Planning Benefits. On our panel today, we have HBKS Wealth Advisors Principal and Senior Financial Advisor Brittany Taylor, from HBK's Tax Advisory Group, Principal Ben DiGirolamo. We have Ashley Walters, President of Onyx, and from Business Transition Advisors, Senior Vice President Dan Zugel. Our session is scheduled for 60 minutes and has been previously recorded. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. We value your feedback, so please complete the survey at the end of the session to let us know how we did. If you'd like more information from any of our presenters, please let us know via the survey or by email. And for more information and insights, please visit our Insights page at hbkswealth.com/insights. Ashley, let's get started with you because really it's your story that brought this group together. So if you wouldn't mind, start by telling us the journey that you and your husband Drew took to become second-generation business owners.
Sure. So Drew and I started in 2013 with a turnaround of the family-owned business, Onyx Incorporated. His father owned the business, and he had a leadership member that was very command and control in his leadership style. So we'd really gotten away from our family-centric values. So in 2013, I led the turnaround, took a look at the financials, really improved our performance. And in 2018, Drew and I did end up purchasing the business from his father in its entirety.
Thank you. So at 40, some may think that this is too young to be thinking about retirement. What do you each see as the benefits of planning for succession so early?
I can get started. So ultimately, my goal is to work with families and individuals on planning for their financial future. So ultimately, planning always sets you up for success. If you don't have planning, then there's a lot of times you're not going to meet your goals. And so the earlier we start, the better off we are, because we can start in smaller chunks and goals early on, whereas if we wait till it's too late, then we have to come up with absorbent amounts to be able to meet our clients' goals. And we're having conversations of you're going to have to work later, you're going to have to spend less, all of those things kind of incorporated. So the sooner we can start, the better off you really are for planning for your financial future. And I think that's typical of business owners to really focus on their business and not necessarily their personal situation to put themselves in a good position.
I agree, Brittany. I'll add to that. That was dead on. That by starting early, it leaves all the options on the table. Sometimes when you wait too long, you're stuck in a few things that could possibly work based on health or time frame or financial situation. By starting early, everything's on the table. And just because you start planning early doesn't mean you have to walk away early. Like Ashley and Drew, young to maybe sell a business in general terms, but they left all their options over. They're not running anywhere anytime soon. And so they have the options. They control their destiny, not letting the circumstances control what they had to do.
Yeah, you're spot on, Dan. I mean, for us, it ensured that there was business continuity for both the clients and the employees, and that we weren't relying on somebody to make a hasty decision if something happened to Drew and I.
Yeah, and that's a great scenario. What's worked out for Ashley and her business. At HBK, we work with many business owners and family-owned businesses, and in being able to start thinking about what that end game is or that goal for you and your family and your business is so important, because in the alternative, as Dan mentioned, when you start early, you have all of the options. And unfortunately, we see the opposite result sometimes, where there hasn't been proper planning and you get to an event in life, in the business or in that family that requires a sale or requires a transfer of ownership that you didn't have time to really think out and understand what the best thing for you, your business, and your family would be. If you start that process early, nothing's fail-proof, but or foolproof. But you can avoid so many of those situations, liquidity issue with your family or with your business. So it's a conversation that we like to have with all business owners, regardless of stage in life, of stage of ownership. It's important to know what it is that you want to do with that business, so we have all of those options available to us in helping you achieve those goals.
Very good. Now, before we get too far into the conversation today, I think it would be helpful for our listeners to understand, Dan, from maybe you can start, what is an employee stock ownership plan and how does it work?
Yeah, sure. Thank you. Yeah, I'd love to tackle that. An ESOP, or employee stock ownership plan, it's a lot easier to say ESOP, obviously. So ESOPs stands for employee stock ownership plan. Some people confuse it with employee stock options. They're completely different things. An employee stock ownership plan is a defined contribution retirement plan, just like a 401k. It's covered under the same code sections under federal law. We have to follow the same rules, discrimination, testing, contribution limits, and the like. The difference between like an ESOP and say a 401k is where a 401k takes employee deferrals, maybe some corporate match, and goes out and invests in maybe mutual funds of a mutual fund family, and it grows towards retirement. ESOPs are similar, except it has one primary investment, and that's the stock of the sponsoring company. ESOPs were designed to provide a liquidity event for selling shareholders while benefiting the employees who don't have to contribute any out-of-pocket cost for the company. The government offers very significant tax incentives for businesses to sell their business at full fair market value to the retirement plan, and those tax benefits are what offset any financing or any loans we may have taken out to buy the stock from the selling shareholders. So as that is the summary, here's how it physically works. And we'll just use a bank as an example here as a way of finding the money. The company will borrow money from a bank. Right? I'm sorry, the ESOP will borrow money from a bank. The ESOP says, great, I have money. What do I do with it? Well, I'm going to buy stock from the selling shareholders. Then the company makes contributions to its qualified plan, which is the ESOP, every year, and the ESOP takes that money it just received and pays off the debt that was incurred. So that's how it flows. There's some big charts we can do and spend a half hour going through the chart, but the ESOP borrows money, uses that money to buy the stock from the selling shareholders. The company uses cash flow and contributes it to the retirement plan, which is the ESOP, and the ESOP turns around and pays off the debt. Now, we perhaps get into some tax benefits a little later, but the tax benefits that we'll discuss a little later are what allow the company to make those contributions without affecting the operations of the business.
Very good. Thank you. Ashley, ultimately, you and Drew decided that an ESOP made sense for your company, but what other options did you consider?
So Drew and I weren't on the path to set out to sell the company when we came to this ESOP decision. What we were on the path to do was understand what the company needed to look like in the future for a transition. And the reason we were on that search is because we had such a hard time making that transition with Drew's father. There weren't a lot of options because of the financial state that the business was in. And then for us as a family, there were all sorts of different maybe succession planning options that would have had some tax advantages to them. Ultimately, Drew and I just ended up purchasing his father outright with after-tax dollars. But we just wanted to understand like what all of our options were. So of course you could, transition it to the third generation, but that comes with its own complications. You could sell it to a key employee or a partner, or you could go third party, whether it be private investment or a strategic type buy. It was the ESOP that made us feel like the most comfortable though.
Now that you mentioned third party, that's something that I think we should explore in this conversation. And since that isn't the path that you chose, what are some possible drawbacks to selling to a third party? Brittany, maybe start with you, and then Ashley, you can join in.
Yeah, definitely. So, not to speak to what Ashley's and Drew's thoughts were on it, but in my experience, I've worked with some business owners that did sell to a third party, a key employee, And essentially the financing, as Ashley was referencing, when they purchased out her father-in-law, just wasn't available. And so they had to make deals as far as, okay, we'll pay X amount now, and then over a certain time period, we'll continue to pay to get you your full amount. And so unfortunately, in some of those cases, the businesses didn't do well after the owners left. And then they ended up, defaulting, going into bankruptcy, and then the owners didn't get their full value back, which really hurt them from a financial planning standpoint. So not to say that's the case all the time, but that is, a possible negative to selling to a third party from my viewpoint.
And for us, selling to a third party just didn't feel good, because while I know that there's plenty of private equity funds out there that are great businesses, we've just heard so many horror stories in our industry of private equity coming in and reselling you again in 3 years and kind of stripping the cash out of the business. And we had just worked so hard to turn the business around, like it would just be crushing for us to see it go a different way. Also, an ESOP allowed us to keep the business here in Erie with the same management team. We're a big part of the community here, and we wanted to make sure that the business stayed that way for generations to come.
That's a big point, right?
Thank
you. That ESOP companies keep jobs, which is one of the reasons the government likes it. And Ashley and Drew felt very passionately about the hardworking employees at Onyx and wanted to make sure that they kept their position, because many times private equity or somebody else will come in, maybe take a patent or have their own management team, lay off all the key managers at a firm. And Ashley and Drew were dead set against doing that. And it's very admirable, Ashley.
I'm sure many people who will be watching this can see themselves in this story. So I'm curious, Ashley, as you continue to share more, what do you suggest business owners consider when deciding if selling to the next generation is their best option?
Yeah, so for Drew and I, we just could see statistically, and we're engineers, so we kind of go straight to the numbers sometimes, but the third generation is only 13% successful in a family-owned business. And there's various reasons for that, but if you are approaching that third generation or further on down the line, I just really encourage you to think about and ask the children whether they love the business. You would never want it to be like a fallback plan for them or make them feel like it's an obligation for them.
Yeah, and
Anything to add to that?
Yeah, I would agree with you on that too, Ashley, because in that case, sometimes the parents think, okay, my kids will take it over. Again, financing would be to pay them over a period of time. And if the kids aren't engaged or it's not something they love to do, the business isn't as successful. A lot of times the parents or the owners stay working a lot longer than what they wanted to just keep the business going. So.
I think often when we're having these conversations, it's with business owners whose children are a little older. Now, Ashley, your boys are 9 and 11 years old, but they were still engaged in this process. So I think everyone would be interested in hearing how your boys felt about your decision to sell the company to the ESOP.
Yeah, so from the time that we even knew about it, we had them sit down and watch the ESOP videos that we could find on YouTube. Certainly they didn't spend as much time researching it as we did, but we just had that conversation with them about how did they feel about it. And like you said, they're so young at 9 and 11, they really don't know how to feel about it. However, I will say that they supported us in that decision, and it was a family conversation. They even attended the ESOP announcement, the party. They were very adamant that they were going to be there and celebrate with everybody. And even this morning, as I asked them, in preparation for today, how do you feel about it now that we've done it and sold the company? And they were like, you mean to the ESOP? And I said, yes. And they said, well, we hope we work there one day. So they're young enough to, still love the company, love what we do. They could give the plant tour just as well as I can, for sure. But at 9 and 11, I also have to be honest with myself and say, we have absolutely no idea what's going to come in their lives. We don't know what they want to be when they grow up yet, right?
Absolutely. So let's talk about that a little bit more. When we think about an ESOP, can it work in a family business? What role does the family play? And the question that certainly comes to mind for me with employees as owners, do they run the company? Dan, maybe we can start this one with you.
Yeah, sure. Well, Ashley and Drew are proof that ESOPs work in family businesses. And frankly, that is one of the myths of ESOP. I have people say to me, Dan, I'd like to talk to you about an ESOP, but it's a family business. I'm like, well, sometimes that's the perfect situation in which to consider an ESOP. When families that, depending on, it doesn't matter how long it's been in the family, grandma might have started the business and don't want to sell it to an outside buyer. Want to keep that family name intact and grandma and grandpa's picture in the front foyer. And it's just simply expanding the definition of what family is. Mm-hmm. Ashley and Drew felt passionate about their employees and said they're kind of an extension of our family. And so by expanding that definition and keeping the family name and the legacy and it keeps that intact. But in addition to that, more practically, to lead into the questions, what role does the family play? Well, Ashley still runs the company post sale. ESOP owns 100% of the stock, and she still runs the company. And so that's often people say, oh, well, I don't want to sell more than 51% because I'm going to lose. I'm not going to run the company anymore. And that's not true in the ESOP world. The family or designees can continue to run the company for as long as they want to, control the board, and have all the management positions, and sharing some information with the employees, but not confidential information such as payroll and things of that sort that you normally would not share with employees. So, and so the question was, do the employees run the company? And the answer is no. However, Ashley and other successful ESOP presidents share relevant information about the growth of the company. How are we doing? Here's what affects our value, our corporate value here. We lost money in this area, so it hurts our value. So people are in it together, and it's more of we're all in this one big family in this thing together. And so information and communication is very important in an ESOP. So I guess I'll stop there.
Ashley, when you mentioned that the ESOP felt right for you, what was the guiding principle that led you to that feeling like the right choice for your business and your family?
I think Dan nailed it right on the head. Selling the family business to family, we just expanded the definition of family. One of the best Christmas presents Drew and I ever got from the employees here at Onyx was a Christmas card that said, "From your Onyx family." And so that's truly how we've been operating. Our core values are very similar to what you would find in a family. We're here to support one another. We're here to pick up the pieces when, somebody's having a bad day or things aren't going well, or we just have to work together as a team. So once again, it's back to that culture. We have, a culture of continuous improvement here. People are allowed to make decisions. We understand that, some experiments are going to fail, but we're always looking to improve. And we're looking to do that as a core group of people. So that it just, for all those reasons, made sense to go an ESOP.
Sure. How important do you feel an organization's culture is as a factor in choosing an ESOP?
I think for us, culture was like one of the definitely guiding principles. I would say that I think culture in any merger or acquisition is probably a pretty important piece of it. So I think it plays a big role.
Thank you. We're going to shift the conversation a little bit now. Ben, we teased this at the beginning when we talked about the tax benefits of ESOP. So if you wouldn't mind shedding some more light on the special tax considerations and benefits of an ESOP.
Sure. Yeah. Anyone considering selling their business needs to consider the tax ramifications of that sale. It's a significant factor in any sale or projected sale of a business. And talking about ESOPs, there's some significant benefits that can exist to both the buyer and the seller when we talk about taxes. And it starts with how is the entity structured for tax purposes pre-sale. Very many of the businesses that we work with at HBK and a lot of the businesses, frankly, around the United States are taxed as S corporation. So the business that you own generates revenue, and the owners of that business under an S corporation, a flow-through tax structure, are who pays the tax on that income. The alternative to that is a C corporation, where the corporation itself is the taxpayer and pays the tax on the income of that activity. And if whether you're an S or a C, there can be benefits to selling to an ESOP. And as I mentioned, most of the businesses that we work with, they receive an annual benefit from being a flow-through entity and being taxed as an S corporation, having the owners pay that tax. When you're organized as an S corporation and you sell your stock to an ESOP, then the ESOP becomes the payer of tax on the activity of that business. The income would flow through to the ESOP. Now, it just so happens, as a qualified retirement plan, that ESOP is not subject to tax. It does not pay tax on the income of the ESOP. And so after the sale, the ongoing business that may have been paying an effective rate of tax of 30% or more, when you factor in federal taxes and you factor in state taxes, you can easily get over 40% in annual income taxes from the business. That income may no longer be subject to tax as it's owned by the ESOP, and the ESOP is exempt from paying tax. And Dan can help us understand how incredibly important that is, or helpful that can be also to the seller. And I'll go on for just a couple more minutes, Dan, and then I'll turn it over to you on that point. But that's also beneficial to the seller, because the seller is receiving a revenue stream from the sale of the stock, and it helps the business be able to meet that obligation to pay the seller. And in addition to that, the seller often continues to have an equity stake or some sort of ownership, either through the ESOP. It provides benefit to the owners of the ESOP as they're owning a business that no longer is subject to income tax. So the sale of the S corporation can be beneficial to both the buyer, who is going to be a tax exempt entity and gets the benefit of that flow through income not being subject to tax, and the seller. The other scenario that we see frequently is a sale of a C corporation to an ESOP. And if an entity is structured as a C corporation, where the C corp itself is the taxpayer, when that's sold to the ESOP, you don't get necessarily the benefit of having tax-free income, because the C corp would still be the payer of tax on the income, not the ESOP. However, there's a benefit that exists to the seller in those scenarios. It's a specific code section under the Internal Revenue Code. It's section 1042, that allows a seller of a C corporation to potentially roll the cash that they receive from the sale, the proceeds, into other stock investments and defer gain. And so typically we recognize gain on the sale of stock. It's whatever our basis was, our cost basis in that stock versus the proceeds. The difference is our gain. That built-in gain can be rolled into similar investments of stock if you're selling a C corporation. So the potential is there for the seller of a C corporation to an ESOP to roll the proceeds it receives into a diversified portfolio and put a deferral on payment of tax, so long as they continue to hold the stock that they reinvest in. Now, Dan, I mentioned the benefits of an S corporation, and how that would benefit the seller as well as the buyer, who wouldn't be subject to tax. And this is something you and I talked about just last week.
Yeah, exactly. And to kind of tie together, when I talked at the beginning about how it works, the ESOP borrows money and then buys stock, and then the company contributes money to the ESOP, and the ESOP uses that to pay off the debt. And I said there's some tax advantages that provide the cash flow in which to do that. And that's exactly what you just said, Ben. When the profits aren't taxed anymore, the company no longer needs to give the previous owners money to pay their tax, because now the current owner doesn't pay tax. So the company says, we no longer need to declare distributions. We don't need to give anybody this money anymore to pay tax, because nobody's paying tax. So instead of using the money for tax, we'll turn around and use it to pay off the loans. So we're using what used to be tax dollars are what's now being used to pay off the debt that was incurred to even buy 100% of the company. And that's about what 65, 75% of all ESOPs are are 100% ESOP owned S corps because the ability to use tax dollars to pay off the debt instead of going to Uncle Sam. Ashley, how's it been for you as a president of a company that doesn't pay tax on profits?
Yeah, it's been pretty good. We're only 6 months in, but I can't say that I missed that. But it's a huge benefit, Dan. To your point, I mean, part of the struggles that we had when we were trying to transition the business from Drew's dad to ourselves is we as the buyers were having to pay with after-tax dollars, and that is burdensome, right? So now the ESOP, the employees never put a dime of their own money in. They just have to come to work and work hard every day. But we get the benefit of not having to pay the federal and state taxes in order to help pay off the seller's notes.
Yeah, yep. And there's one thing I was remiss earlier. Please excuse me for jumping in again. When I was saying how the ESOP works, but yes, the ESOP bought stock, but it does go into employees' hands over a period of years, usually 20 to 30 years. ESOP buys the stock up front and then allocates it over a 20 to 30 year period as a really, really nice employee benefit. It's something Ashley can recruit to. Hey, come work for us. For the next 25 years, we're handing out stock. All you have to do is show up, work hard, and grow value. And then when you retire, and Brittany, this is your expertise, but when you retire, employees, you cash out. And you take your money and roll it into, maybe an IRA or something that Brittany would recommend. Right, Brittany?
Yeah, you'd be able to roll it into an IRA. So it's just added additional dollars from, we always recommend that you defer into your 401k and save, but these are additional dollars that are provided to these employees that wouldn't have had it otherwise. And they have that upside potential of growth of the company, not to mention that the owners get to continue to participate in the upward mobility of the business also, because just because they sell it to the ESOP at this point doesn't mean they don't get that continued growth. So I think that's important to note too, is that they still get to benefit from that continued growth also.
I'd like to take the conversation back just a few steps to some of the tax benefits that Dan and Ben were sharing with us, because I'm sure many people watching this are going to think that sounds too good to be true. Certainly my reaction as I'm hearing this. And we have to wonder, is there a concern that the government could do something to change these advantages?
Ben, would you like to run with that, or like me to take a stab?
Yeah, I mean, you live in this world. I mean, my thoughts, there's tax rules can always change, so there's no certainties. But I like what you said earlier, Dan, that this helps provide value to the workers, the owner that become the owners of the business, and it generally is something that you see the federal government likes. And so to close the tax loopholes would close some of that benefit that they see.
That's right. In fact, they really like both federal government and state governments really, really like ESOPs. In fact, there's no talk of getting rid of any ESOP tax benefits or benefits whatsoever. In fact, there's only talk of adding tax benefits. Ben did a great job differentiating C Corp benefits from S Corp benefits. Well, they're saying, why are we making people choose? Let's give everybody all the benefits. It's just because the tax law is a little antiquated. So there is reintroduced legislation to actually do that, and to close and to correct some things with minority and women-owned businesses that aren't quite right. So they actually want to increase the benefits. And you have both parties that really like it. You have the one side, the Bernie Sanders of the world, saying, hey, employees are finally getting what they deserve, the rightful owners, the employees, right? You have the other side that says, hey, we love businesses with tax breaks, and we love employees with independent wealth. The more people with independent wealth, or less people we have to take care of on the government safety nets later on. And we give businesses tax advantages, they grow, they hire, and they expand product lines and do different things of that sort. So the overall tax revenue, they believe, is much greater when people keep their jobs and work hard and companies grow than the actual tax revenue they're giving up by allowing business owners to not pay capital gains tax, and for the business itself not to pay tax on profits. But when you have all these employees and more employees paying income tax on their big paychecks and their big retirement plans, they think it's well worth that. And so that's why the government likes it. Nobody in the community has any fear whatsoever that anything negative for ESOP tax benefits are going to be affected, only positive going forward.
Yeah, and I also want to mention, the question, is this too good to be true? There's nothing under the radar about these tax benefits. This is something that's well known, and as Dan points out, maybe even would be expanded under certain policy changes. So we're not doing anything that you need to worry about, or that Ashley and her husband need to worry about as part of this sale.
It's funny that you brought that up, though. That was Drew's comment exactly when I came home and told him about it after hearing Kevin McPhillips from the PA CEO talk at a succession planning event. I came home and I said, we really need to dig into this ESOP. And he says, Ashley, that's too good to be true. He said, like, you misheard. But we researched it, and it was true. I was right.
Yes. In my general presentation, I put side by side a Bernie Sanders and Ronald Reagan quote, both saying the same thing about ESOPs, which is interesting.
Well, I'm sure that's reassuring for everyone who is watching this, and another reason why we're having this conversation today and sharing this. So Brittany, I'd like to revisit this with you. When you're working with business owners on their financial planning, what obstacles do you see for many of them?
Yeah, I think for a lot of business owners, they're just really focused on the business. And so, a lot of them actually draw very little from the businesses. They put a lot more money back in. And so they don't have a ton of liquidity. They aren't really working on or planning to build wealth outside of the business. And ultimately, we'd all love for our businesses to be successful, but as we know, that's not always the case. And then we have situations like what we're in right now, why we're on this type of a virtual webinar, that, unforeseen circumstances can present themselves, and, some businesses flourished during this time period, but some businesses didn't, succeed. And so if you were at that standpoint of having all of your investment or wealth in your business, then you don't have that potential to save or have that wealth outside of the business, which is concerning. And depending on your age, very difficult, if at all, that you can recover from that. So, I would say liquidity is the big thing, building wealth outside of it, not really thinking about their future or planning. So we kind of mentioned, potentially selling to either a third party that doesn't have the funds, or children that don't have the funds, so they're not able to plan. And then they end up working a lot longer than what they really intended to. Not to mention that they're not doing things like protecting themselves from a life insurance, or for life insurance for their family. So if everything's in the business and they didn't think about having life insurance to protect their family, or disability insurance, all of those things, a lot of times business owners, and I get it, I'm very focused in my work, so sometimes we forget about what's going on in our personal lives, but if we don't do that, then we're not protecting our family, and we're not putting ourselves in our situation to achieve our goals. And so I think if you have that combination of, if everything goes well with the business, you have that wealth, but also you have to think outside of your business of, what if things don't go as planned? How can I still meet my goals? What does my retirement or my future look like in the end? And then working with a financial advisor, that's what we do, is we really help visualize those goals, and then we help determine, here's what your resources are, here's where you want to be, and here are the things that we can do to put you in that situation to meet those goals. So I would say that's probably the biggest thing, in time, right? Business owners have a limited amount of time. So having somebody help you to focus on that is really important.
Thank you for that. Dan, Ashley has been a great example of how a business was able to successfully implement an ESOP. We might have others on the phone who are still wondering, is this right for me? So can you give us some other examples of, what does an ESOP candidate look like?
Yeah. Generally, there are expenses in ESOP, both setting them up and ongoing. So we need to make sure a company can absorb that both upfront and ongoing. So generally, we want a business probably worth somewhere $5 million value or more, 20 to 25 or more employees, $1 million of payroll, because there's some contribution limits as a percentage of payroll and things of that sort. So we need a certain critical mass to make everything work, and it really revolves around positive cash flow. Now, it's nice when you're not paying income tax on the profits. That really helps cash flow, that equation of things. But cash flow is very important in an ESOP. But so those are just kind of some rough numbers. You know, everything, there's exceptions to everything.
Thank you. And Ashley and Drew, as you can tell, Ashley in front of us today, they're relatively young to have sold their business. And we talked about earlier in the conversation, you know, the benefits of thinking about retirement younger, planning for all of this. But when does it make sense to consider selling to an ESOP or to anyone else?
Well, just about any age that you're thinking about, when do I want to either take some chips off the table or all the chips off the table, or when do I want to physically walk away? Any scenario in which those two things, you know, are present, one or the other are present, it's, you know, it could be worth considering. But I will say it will take 5 to 10 years to completely walk away. So that is, you know, one of the things of an ESOP. It's not get all your money up front and walk away. There are, you know, you probably want to stick around for a little while till all the payments are made and you have everything that's owed the business owner. So you probably want to look for a runway of about 5 to 10 years.
And I think that stresses the importance of planning early. So not, you know, just waiting till, okay, I want to be done next year. In any of these situations, it makes sense to make sure that you're planning ahead to be prepared.
And early planning and preparation are certainly things that we saw from what Ashley has shared so far. Ashley and Dan, what are some of the other keys to a successful ESOP?
May I take it?
Yeah, please.
Okay, so from my perspective, I think open, honest, transparent communication was really key for us, and we had that in the business ahead of the ESOP transition. So I pulled everybody from the leadership team in on March 9th. We're a relatively small company, you know, 50 employees. And I knew that like rumors could start flying pretty quickly that we were selling the business. And I just wanted to make sure that our leadership team knew that we were not in fact selling the business to somebody outside of the business, but to them themselves. And I even had Kevin McPhillips, who I mentioned before, come up from the PA CEO group and just talk to them and answer any questions that they might have about how an ESOP worked. Well, then of course, as we know, the world shut down just 2 weeks later. So they were all excited about this transition. And then the question was, are we actually going to get to do this transition? And so each of them kind of came individually and asked that question. But you can see that they knew that I would answer them openly and honestly. And I told them it made good business sense, you know, in December for us to think about it. And it still made good business sense in March, even with everything that was going on. So we did, you know, pursue it. But just that open, honest, transparent communication is really important.
Yeah. And I'd say everything we already talked about, and Ashley just summarized that perfectly, but culture, caring about the employees, cash flow, and communication are the key things.
Very nice. Now, I'd like to hear from each of you, from your perspective, who benefits from an ESOP?
So I can start. I mean, Drew and I as owners benefit from the ESOP. It gave us an opportunity to transition the business that might not be as traditional as some of the others that had been presented previously to us. Our employees are certainly going to benefit. The statistic is that they'll have 2.5 times more in retirement than what they would have had with us matching their 401k. And then once again, I really think that the community benefits and that we remain a business here in Erie for generations to come.
Yeah, and I would piggyback and you know, concur with everything that Ashley said. I mean, from a financial planning standpoint, it benefits the owners, right? Because they have that opportunity to get some liquidity earlier on, so they can really plan and build their wealth outside of outside of the business, along with making sure that they have everything in place to protect their family. And then also for the employees, you know, as Ashley said, these are dollars that they otherwise wouldn't have because they likely couldn't come up with more money to put away or save. So they're already saving what they can. And so, you know, you're caring about your employees and putting them in a better situation for their retirement and really to meet their goals in life, which is, you know, wonderful.
And the only thing I could add to those perfect answers is the kind of what I touched on earlier, community. The community, the state, like Erie, Pennsylvania is important actually. When to keep those jobs, which often go away in a third-party sale. So that's very important to the community, keeps jobs and elevates pay statistically. They have more retirement benefits, less people on the government safety net, more people with higher wages, which is the reason not only federally there's pending legislation. We just got through the Pennsylvania House, for those on the call that are in PA, got through the Pennsylvania House pro ESOP legislation to actually increase the tax benefits in the Commonwealth. So in both parties, bipartisan down the middle, and Governor Wolfsky is going to sign it. So it does good for the community and does well for the community, I guess I should say, and the state. And actually, you can still support your charities and different things you do as the person still running the company versus some company from out of state or out of the country that may say you can't do those kind of things. So that's it.
Those are all incredibly important things, and so to finish with tax, something a little less important. I see benefits to both the buyers and the sellers, and I think something Ashley said was so interesting when she and Drew had the taxable acquisition of the business from her father. It was a strain on them to make those payments with after-tax dollars. And in this situation, that's something that the ESOP doesn't have to do. So the ESOP, the owners, the participants of the ESOP get the benefit of being able to acquire that entity with after-tax dollars, and the after-tax, it happens to be 100% of the profits of the business. And of course, we talked about the benefits to the sellers as well for tax purposes.
Those were all fantastic answers. Thank you. Ashley has already demonstrated to us that this is something that could be executed in the middle of a pandemic, and something that certainly no one had anticipated in our lifetime. Are there any other reasons or excuses, as you can think about someone, again, who's listening to this and wondering, you know, why should I consider this now? Dan, Ben, from your perspectives, anything you'd like to add there?
Ben?
Yeah, there's a tax reason why a lot of business owners are considering sales in 2021. Of course, you all know we have a new president. We've had relatively low historic tax rates for some period of years now, and there's an anticipation that it might be time that we're going to have to turn around and start paying for some of the benefits that have been paid out through these different COVID and pandemic responses. And we have a president who campaigned and has talked about increases in tax rates. In particular, when we're looking at sales of business, the capital gain tax rate is an important one to look at. Right now, we've got beneficial rates that are capped at 20% on capital gains. The president has talked about eliminating that capital gains rate benefit on income over a certain threshold. Now, I think just historically, it's unlikely that we would see a change that would be applied retroactively for all of 2021, but there is some anticipation of a change possibly in 2022 or a year after 2022. So for business owners that are considering sales just in general, 2021 seems to be a good year to start that process. And of course, we've been talking for the better part of this hour about all of the benefits of an ESOP. And so anybody who's considering selling should also be considering the potential of selling to an ESOP in 2021 to achieve that lower tax rate than they may receive in 2022 or beyond.
Yeah, we're seeing a lot of activity coming into exploring 2021 sale because you have, in order to sell to somebody else, an outside buyer, you have 10 months to put together, you know, your materials, find potential buyers, go through due diligence, and close the deal in 10 months to the right and acceptable buyer. That's a short window. However, for ESOPs, it's a very doable window. And so even if you are considering an outside buyer as a backstop, maybe consider an ESOP as well as a backstop. I'm an ESOP guy, so I think it should be the outside sale should be the backup, but that's just me. But I think, ESOP, you do have time to not panic, not worry, and get things done correctly and effectively by the end of the year, whereas the other methods might be running tough on time.
Ashley, one last question for you. For owners who may be considering a succession plan, what advice do you have for them?
Start early, please. In all seriousness, I know I've said it throughout the day, but please start early. It's not something that you need to wait until you're 65 years old and ready to retire to start thinking about. Also, assemble that team of advisors. You're busy running the business. There is no way that you could research and have all the knowledge that you're going to need to make this transition possible. So just make sure you've got a great team behind you. And then I will say that it's personally and emotionally really challenging to sell your business. And I understand that. I've been through it twice now on both sides. And it is worth the hard work to put these teams together and to think about this early on. You get to have control over the process. If you wait, you might not get to control that process.
Well, thank you, Ashley, Dan, Brittany, and Ben for your expertise and for sharing today. If you would like to see if an ESOP is right for you, your family, your company, HBCAS Wealth Advisors and BTA are offering both a complimentary personal ESOP 101 Zoom call and a complimentary ESOP financial review. And for additional incentive, for every ESOP 101 review, Ashley has graciously offered to give you a complimentary copy of her book, Leading with Grit and Grace, A Journey of Organizational Culture Change. Also, please keep in mind that we will be offering part 2 that will cover valuation issues and financing, as well as other relevant topics related to this. So again, thank you to our presenters, and for everyone who is on with us today. We value your feedback, so please do complete the survey at the end of the session to let us know how we did. And for more information from any of our presenters, you can let us know via the survey or by email. Thank you very much.